Hello, welcome to another first class foundation tutorial where we are treating ACC 111 Introduction to Accounting. Good name is Kureje, a 300 level student of the Department of Accounting, University of Lagos. For today, we'll be looking at accruals and prepayments under end of the year adjustments, and then we'll be looking at how we can make necessary adjustments for accruals and prepayments in the preparation of the final accounts or financial statements of a business. So let's do an introduction. Accruals and prepayments are fundamental issues to be considered and treated when preparing the financial statements of a business, that is the income statement and the statement of financial position. So it's important that we take note of accruals and prepayments when treating the financial statement of a business, and this is because of the accrual concept, which states that revenue and expenses are recognized as they are earned and incurred, and not when money is received or paid for them. Because in the course of business activities, certain expenses or income for services received or rendered may not be received or paid in the same period in which they were incurred or earned. So, but based on the accrual concept, in the preparation of financial statements of a business, particularly the income statement, we need to take into consideration this. That is, the income that will be charged in the income statement for the period will be the income that was earned, and not necessarily the income that has been paid for. And the expenses that will be recognized are the expenses that have been incurred, whether or not we've paid for such expense and the business has paid for such an expense. So this simply means that we recognize income and expense when services are rendered or received, and not the time money is received or paid for them. When services are rendered or received, and not when money is received or paid for them. Now, let's define what accruals and prepayments are. You see, this accrual concept, it's applicable in two folds, that is accrual and prepayments. Yes, accrual concept is the basis for which the final accounts of a business are prepared. But it is in two folds, accruals and prepayments. Accrual is the term used for a situation where services have been rendered or received and money has not been received or paid for them. So accrual is a situation of you are owing someone or you are being owed by someone, meaning that you've rendered a service to a particular business or entity, and you've not received payment for that service, or you've received a service from a particular entity and you've not made payment for that service. Prepayment, on the other hand, is when payments have been made or received for services not received. Payments have been made or received for services not received or rendered. Now, in this situation, we paid in advance. This is what we call payment in advance. That I've not received this particular service, but I'm paying you so in advance for the service you render to me. As at that moment, that service has not been received, neither have you rendered that service. So it's either a service received, meaning that I received a service, someone offered a service to me, as in I rented an apartment for my business operations. So that's a service received. And if I've made payment for a year in which I've not occupied that particular property, it means that it's a prepayment. I'm paying for the next year or for another year. And services rendered, in the sense that I'm rendering a service to a particular entity and the entity has paid me for a service for a future period, a period in which I've not rendered the service for. So that's where we have prepayments. Now, based on the accrual concept, like I mentioned earlier, we'll have to make adjustments to arrive at the amounts to be captured in the income statement as income or expense for that period. We'll have to make adjustments because the amounts to be reported in the income statement is the amount of income that has been earned and expense that has been incurred. We don't record expense that has been paid or income that has been received. It's only in the statement of cash flows, which we will not be doing until year 3, that it's prepared on cash basis. That means when payments are actually made. In the income statement, we record expenses whether or not they involve a flow of cash. So whether cash has been paid or received or not, we recognize such expenses or income as long as it is for that period for which you are preparing the income statement. Now, income or expense meant for a preceding or subsequent period, we do not recognize that. So if you are paying an expense for last year, probably you were owing before, you're not going to recognize that in the income statement for this year. If you are paying expense rather for next year, you're not going to recognize it in the income statement you are preparing for this year. So that's what the accrual and prepayment is all about. So there are two divisions of both accruals and prepayments. We have accrued income, we have accrued expense. That's under accruals. We have prepaid income and prepaid expense, because there are basically two aspects or two sides to the income statement: the expenses incurred and the income received. So income received from operations or other income, which in the sense of discount received and all of that. So we have them in two divisions: either accrued income, accrued expense, prepaid income and prepaid expense. Now, accrued income refers to monies yet to be received for services rendered during a particular period. When you talk about accruals, it means there is an owing either by you or by someone else to you. So in the sense of income represents receipts, things that are coming into the organization, funds or resources coming in to the organization. So when it's an accrued income, meaning that an income is being owed, that means someone is owing you a particular fund or money. So that's what accrued income represents, and it is treated as a current asset in the statement of financial position for that period. So accrued income is treated as a current asset because you are being owed by another entity. It means that you have money somewhere that you have not gotten. So it represents a current asset, just as we treat trade receivables. So trade receivables are money that will be received for trade, for sale of goods. So you've not received such money, it means it's a potential income, a potential source of cash. So that's why it's a current asset. Accrued income also is a potential source of cash for the business, so it's a current asset. Now, accrued expense, this refers to monies yet to be paid for services received during a particular period. So you received a service but you've not made payment for that. You occupied a certain premises and you have to pay rent annually. You've not made payment for the rent of that premises. Either you paid in part or you've not made payment at all. So it means you are owing the person you are occupying his premises. So, and that's treated as a current liability because that individual you are owing has a claim on the business. Now, I mentioned when we were treating accounting equation that liabilities are the claims of outsiders on the business, on the assets of the business. So this particular individual you are owing has a claim to an asset in the business, that you are owing me this particular amount, so I'm entitled to this particular amount out of the total assets that belong to your business. Now we look at prepaid income. Prepaid income, money is received for services yet to be rendered. So payment has been made in advance for a service you have not yet rendered. So in this particular case, you can say that you are owing a service, if you could use that. So you are owing a service, meaning that this person has a claim on your business. It's either you render that service or you make refunds for the payment that has been made. So that's a current liability, to be treated as a current liability in the statement of financial position. So while prepaid expense refers to monies paid for services yet to be received during a particular period, and it is treated as a current asset. So you've made payment for a service you've not yet received, meaning that you have claim on someone else's assets. That's a potential source of revenue for your business, because based on your receipt of that service later in future, it's a means by which you can get revenue for your business. So to make the necessary adjustments, you have to prepare the ledgers, and so we'll be looking at the ledgers next. So this is in the situation we have accrued expense or prepaid expense. So we are treating the expense part of accrual and prepayment. Now this is the expense account. We have opening balance for prepayment, opening balance for accruals. We mentioned that prepaid expense is a current asset, and from our knowledge of double entry, we know that an asset account is meant to have a debit balance. So that's why the balance of prepayment is on the debit side, because prepayment is a current asset and assets are meant to have debit balances, while accrued expense is a liability, and liabilities also have credit balances from our knowledge of double entry. So that's why it's being credited. And if you look at it, I mentioned during the double entry principle, when we were discussing on double entry principle, that you cannot sustain your knowledge of double entry on giving and receiving. If you want to approach this particular topic with that knowledge of who is giving, who is receiving, you would not understand this. You would get confused and all of that. So that's why we are knowing it based on the steps I gave. If you've not watched that video, you can check this channel. You will see the video there on double entry principle. So you mentioned that you must know the accounts, the balances an account also have. The assets have debit balances, liabilities, credit balances, income debit balance, and income credit balance, and expense debit balances, then capital a credit balance. So for prepayment, which prepaid expense, which is an asset, a debit balance, and that's why the balance brought forward is on the debit side. For accrual, it's a liability, and that's why the balance is on the credit side. Now for this cash paid during the year, when payment is made for an expense, we credit the cash account and debit the expense account. So this is an expense account, and what are we doing? We are debiting it with the cash that was paid, because we will have credited the cash book and then we will debit the corresponding account, which is the expense account. So that's why cash paid during the year is debited. Now for a moment, we would assume the income statement, the posting to income statement is not there. So when we have the closing balances of accruals and prepayments, because a standard question, you will be given the opening and closing balances of accrual or prepayments, or both, and then you have to calculate the amounts to be charged to the income statement. That's the reason why we are opening this account. That's the goal. So like I said, that the balance of prepayment is going to be debited because it's an asset. That's why the closing balance of prepayment is also debited, and the closing balance of accrual is credited, just as the opening balances are, because the balance is whether opening or closing is meant to be on the debit side if it's an asset, and on the credit side if it's a liability. Prepaid expense is an asset, accrued expense is a liability. So from there we can work back to the balance carried down, and we know that the balance carried down will be on the opposite side of where the balance brought down was. So there will be an amount that will be left, and that will be the balancing figure. It is the balancing figure that will be posted to the income statement as the expense for that year. It is the balancing figure that will be posted to the income statement as the expense for that year, after making adjustments for both the opening and closing balances of accrual and prepayment and the cash paid during the year. So I believe that is clear. So basically, from what we did in the ledgers, if you want to approach it in a faster way, what we are doing is to deduct from the amount paid as expense during the year. We are going to deduct the accrued expense at the end of the previous year. that's the opening balance of accrual, and then add the closing balance at the closing balance of accrual at the end of the year. That's the accrued expense at the end of the current year, the closing balance. So we are subtracting the opening balance and adding the closing balance of accrual to the amount that was paid during the year. That would give you the amount to be taken to the income statement as expense for the year. So this implies that the expense paid, that is the cash paid during the year, minus the opening balance of accrual plus the closing balance of accrual, will give us the expense for that period, the expense incurred for that period. Now on the other hand, we add the opening balance of prepayments and the closing balance of prepayments. That means the prepaid expense at the beginning, we are adding that, and the prepaid expense at the end, we are subtracting that from the amount that was paid during the year. So which means that the expense paid plus opening balance of prepayment minus closing balance of prepayment will give us the expense for that period. Now let me explain this. When we look at accruals, we said that it is an amount that is the business is actually owing, right? So it means that the opening balance of accrual represents the expense for the previous period. And I mentioned that what we are recording in the income statement is the expense for the current period. The expense for the previous period or the subsequent period would be deducted, will not be charged to the income statement. So the opening balance of accrual represents the amount that was owing for the previous year, and that is the expense for the previous year. So we are subtracting that from how much was paid, because we assume that we would have paid that first before settling the one for this current period. So we are going to deduct the accrual for the previous year, meaning that it's an expense for the previous year. We are subtracting it from how much was paid. Then the closing balance of accrual represents how much expense for this period is yet to be paid. So it's still an expense for this period according to the accrual concept, even though we've not paid completely. We are going to add it to the amount that was paid to give us the expense for this period. For prepayment, on the other hand, the opening balance represents an amount that was paid for the next period. Last period, from the previous period, we paid more than the expense for that period, meaning we are paying for a future period. And the next future period is this year, which we are preparing. So we are adding that to the expense paid, and then we are subtracting the closing balance of prepayment. Closing balance of prepayment implies that we are paying for the next period, and so that's why we are subtracting that. So I believe that is clear. Now we look at accrued income, prepaid income. We just treated accrued expense, prepaid expense. So this is just a reverse of what we have for the expense account. For the expense, we debited the opening balance of prepayment. Here we are crediting it. Why? Because prepaid income is a liability. We mentioned that earlier. So and liabilities also have credit balances. Then the balance of accruals is going to be debited because accrued income is an asset, a current asset. So assets are meant to have debit balances. So the cash received during the year, when cash is received from income, we debit the cash book and credit the income account. You mentioned that income account is meant to have a credit balance, so meaning that additions to income are going to be on the credit side. So we debit the cash book, we credit the income account. That's why we are crediting this income account with the cash received during the year. And the closing balance of accrual will be debited, being an asset, and the closing balance of prepayment will be credited, being a liability. So our balance carried out will be on the opposite side of both. Then the income statement, the amount to be taken to the income statement will be the balancing figure, and the balancing figure would usually be on the debit side. For expense, the balancing figure will be on the credit side. For those of you that were familiar with the T format of preparing the then called profit and loss account, you know that expenses are usually debited, and that's why the amount to be charged to income statement would be on the credit side of the expense account. So double entry is completed. But now we are told it's not called an account, so it's a statement. So in that sense, basically the balancing figure, where the balancing figure is, and it's usually meant to be on the debit side if it's an income, and on the credit side if it's an expense. If you are getting it on another side, it means that you made an error in your calculations. So basically, we are deducting from the amount received the same way we did for expense. Now, the treatment of accrual based on the summarized way of treating them is the same thing. We are subtracting the opening balance of accrual and adding the closing balance of accrual. And for prepayment, we are adding the opening balance and subtracting the closing balance. That was what we did for expense. That's the same thing that we apply for income. So whether accrual or whether income or expense, we usually subtract the opening balance, because accrual, like I said, is an owing from the previous period, the opening balance, and so we are going to have to deduct that because it's not for this period. Then the closing balance of accrual is for this period which has not been paid, so we are going to have to add that up, being an expense for this period. For prepayment, the opening balance is an expense for this period which was paid from the previous period, so we are going to add that to the income received, and we are going to subtract the closing balance which is for the next period from the income received for this period. So let's take some examples. Richard and Co left part of their office premises in order to generate additional income to Clement, a sole trader. Clement had an outstanding payment of 8,250 for 2019. He paid 62,500 in 2020, which included 3,250 in advance for 2021. How much is the rent expense of Clement for 2020? How much is the rent expense for Clement for 2020? Now this is the rent expense account. Now the opening balance is going to be credited. Why? Because it is an accrued expense. Accrued expense, we said, is a current liability, so that's why we are crediting it 8,250, because we are told it's an outstanding payment for 2019. We are calculating the rent expense for 2020, so the outstanding payment for 2019 is not part of the expense for this period. It's the opening balance, that's 8,250. Now we are told that he paid 62,500 in 2020, so that's the rent paid during the year, 62,500. That's going to be on the debit side, just as we did in the format, because if he's paying an expense, he credits his cash book and debits the expense account, so we are debiting the expense account here. Then we're told that out of that 62,500, it includes 3,250 in advance for 2021. That's a payment in advance. That's a prepaid expense. And prepaid expense, we said, is an asset. So meaning that the closing balance is going to be on the debit side. So that's why you have balance brought down 3,250 on the debit side. Then balance carried down will have to be on the credit side. So that will be 3,250. Now, like I said, that for expense, the balancing figure, the amount that will be taken to the income statement, will always be on the credit side. So we already know that the amount to be taken to income statement is on the credit side, but assume we do not know the amount. Then we can find the total. You know that there's no other entry coming into the debit side, so the total will definitely be 62,500. Then the balancing figure, that means the difference between the debit and credit side, will give us 51,000. And I said that balancing figure is what will be taken to the income statement as the expense for that period. The rent paid during the year is the amount that was paid, 62,500. Then the rent expense for the year is 51,000, the balancing figure we calculated, and the rent prepaid at the end of the year, which will be taken to the asset side, recorded as a current asset in the statement of financial position, is 3,250 naira. So it's still the same example for the previous example we did, but now we are focusing on Richard and Co. Richard and Co. left part of their office premises in order to generate additional income to Clement, a sole trader. Clement had an outstanding payment of 8,250 for 2019, and they paid 62,500 in 2020, which included 3,250 in advance for 2021. How much is the rent income earned by Richard and Co. for 2020? How much is the rent income earned by Richard and Co. for 2020? So we calculated the rent expense for Clement. So it was an expense to Clement, but an income to Richard and Co. And I mentioned that it's just the direct opposite of that of the expense. So here we see that the opening balance, which is an accrual, is debited because this is an accrued income, which is an asset. So that's 8,250. The rent received during the year would have been debited to the cash book. So we are going to credit the income account, 62,500. The closing balance, which is a payment in advance, is a liability, a prepaid income. So that's why it's on the credit side, 3,250. Then on the debit side, we'll have the balance carried down, 3,250. The amount to be taken to the income statement, which is the balancing figure, I said for income is going to be on the debit side. So if you look at it, nothing is coming to the credit side, so that's 62,500 represents the total. Then the amount to be taken to income statement will be 51,000. So that represents the income earned for that period, not the income received, the income earned for that period. So rent received 62,500, that's the amount that Clement paid. The rent income, that's the income earned, is 51,000. The rent prepaid at the end, 3,250 naira. So let's take another example. Ace Automobiles prepares its accounts to 30th of June annually. On 1st of March 2016, insurance premium of 180,000 was paid for 18 months. How much insurance premium will be charged to the income statement for the period ended 30th of June 2017? Now we need to pay attention here. It prepares its accounts to 30th of June annually, meaning that the accounting period is from 1st of July to 30th of June for every year. Now we are told to calculate the insurance premium to be charged to the income statement for the period ended 30th of June 2017, and that will be from 1st of July to 30th of June, a period of 12 months. 1st of July 2016, 30th of June 2017, a period of 12 months. Now we are told that this insurance premium of 180,000 was paid for 18 months, and it was paid on 1st of March 2016. So 18 months from 1st of March 2016 would be when? Can you think and give me the answer? So that would be the ending of August, 31st of August 2017. If you look at it, 12 months is to February, so it means 6 months. 6 months from February, that's March, April, May, June, July, August. So 6 months, that makes 18 months. Now it means that if the expense was paid in March 2016, it was paid in the previous period. It was not paid in this period. I hope you get it. It was not paid in this period, so it was paid in the previous period, March 2016. That's the period ending 30th of June 2016. So it means that part of this 18,000 has been charged in the period ending in 2016, that's in July 2016. Then part of it would also be charged in this current period, and we'll still have a part to be transferred to the next period, because from March to the ending of to the end of June 2017 is 4 months: March, April, May, June. That's 4 months. So it means that out of 18 months, we've only exhausted 4 months in the previous period, remaining 14 months. Now this our period is only for 12 months, from 1st of July to June 30th of June the next year, 2017. That's 12 months. So that's another, adding 12 to 4, that's 16. So remaining that 2 months would be for the next period. That will be from 1st of July 2017 to 31st of August 2017. I believe that's clear. So now looking at it, we only exhausted 4 in the previous period. We have another 12 here. It means that we've not exhausted all of this expense, meaning that at the end of this period we are going to have a prepayment for the next period. There will be a prepayment for the next period. So that's just to give us that understanding. So basically, to calculate the expense for this period is very straightforward, and that is we have 12 months in this period. The insurance premium was for 18 months, so that will be 12 divided by 18 times 180,000, which will give us 120,000 as the expense for the period from 1st of July 2016 to 30th of June 2017. So that will be the expense for this period. So this is our insurance premium account. The balance brought forward is 140,000. How did we get that? I said that the insurance premium was paid in the previous period, and the expense that was charged in the previous period was for only 4 months. That's 4 over 18 times 180,000, and that's 40,000. So the balance represented prepaid expense for that previous period. So that was the closing balance from the previous period will have been 140,000. I hope that is clear. So the expense that was charged in the previous period was for 4 months: March, April, May, June. So, and the insurance premium was for 18 months. So meaning that out of 18 months, 14 months are still left. So and that will be what will be carried forward to the next period as insurance premium. And because it's a prepayment, so that's why it is balance brought forward. 14 months out of 18 months, that's 14 over 18 times 180,000, giving us 140,000. So the amounts to be taken to income statement. Now we can calculate this very straightforward. You can calculate this directly by doing 12 over 18, because an accounting period is for 12 months. So 12 over 18, because we assume that the insurance premium is fixed for each month. So that's 12 over 18 times 180,000, which will give us 120,000. So we can just balance the account. That's pretty straightforward. So balance carried down will be 20,000, which will be brought down. It's still a prepayment into the next period, so of 20,000 naira. And we can calculate that as we've charged 4 months before, now 12 months. 4 plus 12, that's 16 out of 18, that's the remaining 2 months. 2 over 18 times 180,000 will give us 20,000 as the insurance premium prepaid into the next period. So the prepaid insurance at the end of this period. So the rent expense I calculated as 12 over 18 times 180, giving us 120,000. Then the rent expense prepaid at the end of the year is 20,000. Now, no amount was paid for rent during the year. All we have is a carrying forward of the previous balance, which was able to cover this period and then still have an outstanding or a balance for the next period. So one final example, an Oluwapo has an annual rent of 75,000. On 1st of January 2018, she had rent outstanding of 6,500. On 31st December 2018, she was owing a rent of 3,000. How much did she pay for rent during the year? Now here we are not even calculating how much to be charged to. We are not asked to calculate how much is to be charged to the income statement, but how much she actually paid. So still we would use the same ledgers we've been using. Now the opening balance we're given is the balance of accrual, and this is an expense, so that's why the balance brought forward is on the credit side, 6,500. We are told that the annual rent is 75,000. That annual rent represents the rent expense for every year, so that's the rent expense for this year also, 75,000. We don't have to do any calculation to arrive at that. So then our closing balance, we're given that as 3,000 because it's still an accrual. That's a credit balance, 3,000. Balance brought down on the credit side, 3,000. Then balance carried on will be on the debit side, 3,000. Now to get the rent paid during the year, it is the balancing figure, because you know that rent paid during the year will be debited in the rent account. So what's the balancing figure? The total is 81,500 minus 3,000, which is the closing balance, will give us 78,500. 78,500. So the rent paid during the year is 78,500. The rent expense for the year is 75,000, and the rent accrued at the end of the year is 3,000. 3,000. So that's all for now. So in summary, the amounts to be charged to the income statement as income or expense for a particular period is the amount earned or incurred during the period based on the accrual concept. And the accrual concept states that income and expenses are recognized as they are earned or incurred and not when money is received or paid for them. So I'm just doing a recap of what we discussed so far. So prepaid income is treated as a current liability, prepaid expense is treated as a current asset, accrued income is treated as a current asset, and accrued expense is treated as a current liability in the statement of financial position. So thanks for watching. Ensure you subscribe to this YouTube channel if you have not, and click on the notification bell. Give us a thumbs up if you enjoyed this video. Do also like it and share with all your classmates and friends. And then post in the comments topics you want tutorials on. The semester is fast spent, exams are approaching. So any topic that you might need us to make a tutorial on within the short while we have towards the exam, you can post them and we'll see to them. So see you in the next class. Bye.